Welcome to Wednesday webinar. Tonight I'm going to explain when a repair is tax deductible. Coming up to the end of the financial year, you may be wanting to spend some money on your properties before the 30th of June. Repairs are tax deductible, improvements aren't, so you need to be sure about the difference. If the house needed painting when you bought it, painting it would be an improvement and therefore not tax deductible. However, you would be able to claim special building write-off of 2.5% per year. On the other hand, if during the time of your ownership the paint starts to peel and you repaint, the expense would be a deduction in the year it's incurred. Now, I use the word incurred because if you can't manage to pay for it by the 30th of June, if you at least accept a firm quote, then you could claim it, but it's much better if you just pay for it before the 30th of June. No deduction is available for your own labour, no depreciation is available for your own labour, and you can't reduce or increase the cost base by your own labour. Taxation ruling TR 97/23 is the ATO's authority on whether an expense is a repair or an improvement. Improvements to a property are not tax deductible, and the term improvement includes repairing the property beyond the state it was in when you bought it. Repairs you make to a property when you first buy it are called initial repairs. Initial repairs improve the property beyond the condition it was in when you bought it, so they are not tax deductible. The tax office defines initial repairs as ones that were necessary when you bought the property or became necessary due to a fault existing at purchase date. Even if you were not aware that the repairs needed doing, or even if the price you paid did not reflect the defects, they are still not tax deductible. A repair can be classed as an improvement if it does not restore things to their original state. So, for example, replacing a metal roof with a tile roof is an improvement, and you won't get a deduction for what it would have cost you to replace the roof with metal instead. All you will be entitled to is to depreciate the new tiled roof at 2.5% a year. If you replace the metal roof that became defective over a period of your ownership with a new metal roof, then you can claim that as a repair because you're replacing like with like. You don't necessarily have to use exactly the original materials. Modern materials can be used even when these might be a slight improvement because they are more efficient. As long as the benefit is only minor or incidental, it can still be considered a repair. Replacing something completely or in its entirety is not considered a tax-deductible repair. Replacing or restoring something in its entirety means that the whole of something has been repaired. The something or the whole needs to be separately identifiable. For example, if you were to replace all of the fence on a property, you are replacing it in its entirety. But if it is ultimately replaced by a series of repairs over several years, then it is a deductible repair each year. Replacing a window or a wall in a factory is not a replacement in its entirety because the whole of the factory building is the whole, the entirety. Equally, replacing a roof is not a replacement in its entirety because the entirety is the walls and the roof because the walls are needed to support the roof. If you can show separately the price of repairs done together with improvements and initial repairs, you can still claim these repairs. So it's important to get the bill broken up if you can. While not technically a repair, preventative maintenance is also deductible. The ATO accepts that a house can be in a good state of repair when you buy it. So the first work you do on it might well be considered a tax deductible repair. If, of course, you do this work in the first year, they would be asking, was it tenant damage? What changed? What happened? On the other hand, don't believe that simply waiting a couple of years means you can claim anything without question. If it needed repair when you purchased it, no amount of time is going to change that fact. Repairs are only fully claimable if the property is held solely for producing income. If it was only partly held to produce income, then you can only deduct a reasonable amount of that repair cost, and nothing if you happen to be living there at the time you do the repair. If for the whole financial year the property is rented or available for rent or repaired during tenants, as long as it's at least rented during some of that time, you can claim repairs, even if they relate to damage done while you were living there in a previous year. But it is important that the property actually earn money during the year that the repair is undertaken. Earning money can mean receiving insurance proceeds, fortunately, but if the property is vacant all year, even if it is available for rent, you will not be entitled to claim the repairs. If the tenants move out and you decide to sell, make sure you undertake the repairs before the 30th of June. Then you can still utilise IT 180 to claim a deduction for them. This can also be used if you intend to move into the property yourself, but make sure you do the repairs before you move in, and preferably wait until after the 30th of June before you move in. Delaying those repairs until after the 30th of June will mean that the year in which the repairs were done, there was no rental income earned, so you will not be able to claim the repair. Thanks for watching through to the end. I hope this helps you prepare well for the end of the financial year, and I hope to see you next Wednesday.